I've always thought it was funny how the Fed, the U.S. Fed, is so specific with their words, and when the notes come out of the Fed meetings, people like pour through them and they figure out which words have changed and did the word go from sustained to long term, or did the word go from foreseeable future to, I guess it's a phrase, to for some time. And so there's this whole business behind looking at the Fed's minutes and figuring out what words have changed. And in the change of those words, does it mean that the Fed is going to be more aggressive with the word change or more passive with the word change? And I always thought it was just a bunch of kabuki theater, just kind of silliness. But I have to say, I changed my mind based on what happened this week with the Swiss National Bank and how they did not telegraph their opinions to the world, and they came out and surprised the entire world. And so I think a lot can be learned from the news this week, and I want to talk about how it's impacted what the U.S. Fed's going to do and what the European Central Bank's going to do and what other central banks are going to do, and how it's impacted the S&P 500. Hey everybody, this is RC Peck, and this is my weekend podcast. And my theme for this weekend is how not to do it. And the Swiss National Bank came out this week and clearly told the whole world how not to communicate a new strategy change. So what the Swiss National Bank did is they came out this week and said, we're going to eliminate the peg that we have to the euro. And in doing that, the Swiss franc skyrocketed up. Now, depending on what currency you compare the Swiss franc against, it was either 20 to 40%. Against the euro, it went up about 40%. What's so interesting and sad about this is there are a lot of exporting companies in Switzerland that export their products to the rest of Europe or the euro area, meaning the actual euro currency. So in one day, all of those products have increased in price 40+%, which is pretty sad. And the Swiss stock market clearly communicated that with a 10% drop in one day, something that it has not done in over 2 decades. So how not to do it is to surprise the world. Now, a couple things. What you see on the screen here is a price chart of the Swiss franc against a basket of other currencies, so it's not just against one other currency. The red line is the 200-week moving average. But what's so interesting is the bottom line and the top line, which are trend lines, and how if you look at the bottom line here, it hit that bottom trend line. Now, no one knew what was going to happen, and it immediately moved the price of the Swiss franc against this basket of currencies up to the top trend line. So that's pretty interesting. What's going to happen next is important. Does it stay there? Does it stay at this 115? If you notice over here, there's another peak here. So it's kind of at a double resistance right here. So this will be interesting to watch. And believe you me, the group of Janet Yellen and Mario Draghi have taken note of not to surprise people with their actions. If so, currencies can really get out of, I don't even know what to say. I was going to say out of favor, but that doesn't even make sense. They can really get, they can really get volatile. I have a cold and I'm sitting on my sofa, so my voice might sound a little hoarse today. But this is pretty amazing that the Swiss National Bank has done this, even though it's a very small country and a very small national bank or central bank. It does carry some weight because the Swiss franc historically, though not right now, has connected their currency to gold. And back here in 2011, this is actually where gold peaked. So what will be interesting to see is if gold bottoms here. I don't know if it's a long-term bottom because gold on a weekly and a monthly basis is still trending down. But this peak right here is where gold peaked too at $1,919. And so if this kind of finds us the shorter term or maybe the long term bottom of gold, we should know in the next week or two. The other thing I wanted to look at was how did this kind of currency silliness affect the U.S. stock market? So here on the screen, you see the S&P 500, and you see one horizontal line, which was the high in July. Now, the reason I use the high in July, which is right here, and not this high in September, I guess it's a little bit of August, but it's pretty much September right here, is because I call this a false breakout. It broke above the high, and then it collapsed down. So this high in July is actually the stronger high, and the S&P bounced off it again. So we're at a point now. I mean, as of today, the S&P is up for the day, but we need to watch this one line. Not that if it breaks below it, all things are going to crash, but no need to really pay too much attention until it breaks this line and breaks the low of December, which it may or may not do. But one of the things I like about price charts is you can have these little lines or points where you're like, look, I don't need to pay attention unless it breaks below this line. But definitely the stock market has still an upward trending bias. What you're looking at is the 200-day moving average. That's the red line. It's clearly moving from lower left to upper right, and that is continuing, and it's getting closer and closer to the price. So the U.S. stock market is still in an uptrend. The U.S. stock market is still the favorable place to be. And as things get uncomfortable, it's probably going to be the U.S. where people still send their money. The other thought I had about the Swiss National Bank unpegging, my conspiracy theory part of me says, hey, they must have talked to Mario Draghi. Mario Draghi, the European central banker, he must have said, look, we're going to have to print soon, and we're going to have to print in a big way, and we're going to have to drive the euro down to parity with the dollar. So 1 euro equals $1. And he may have said that to them, and they said, well, look, it's going to be painful no matter when we do this. So we're kind of late to the game, but better now than when the euro has dropped to parity with the dollar. So we'll see. The euro is still falling. The next major support for it, it's low. It's around $1. When the euro first came out back in 99, 2000, it actually went below $1. So it only took 85 US cents to buy 1 euro, and it peaked at its very high, costing 160 cents or $1.60 to buy 1 euro. So it's very likely the next place the euro is going to want to go is parity with the dollar. And there's that line for you to see. And I'll be watching the S&P and keep you up to date on it. So what is the takeaway? Is the EC about to print in huge amounts? Based on what the Swiss National Bank has just done, I'm guessing the probability has greatly increased that they will do some sort of money printing. Look, people are scared. And when people are scared, the place they put their money historically is U.S. dollars and the U.S. bond market and the U.S. stock market. And all three of those are going up. The U.S. dollar is going up against almost every other currency on the planet, except the ones that are pegged to the U.S. dollar. The S&P 500, relatively speaking, is beating every other major stock market in the world. And the U.S. bond market continues to make new lows in the yield and new highs in the price. So much so that the 30-year Treasury just hit lifetime lows. You got that? The 30-year Treasury yield just hit lifetime lows. That's how scared people are. So people are scared right now, so it's a time to be cautious. And the last thing I'll keep you with, relatively speaking, the U.S. is still looking good. Hey everybody, this is RC Peck, and this is just another step in helping you protect your portfolio and your future. Until next time, take care.